Good evening, everyone, and welcome. My name is Lauren Nieves, Head of Investor Relations at Astor Realty Capital, and we're absolutely thrilled to have you here with us today. This is a moment our team has been anticipating, preparing for, and truly building toward for a very long time, and we couldn't be more excited to share it with our network. Before we begin, I want to extend a warm thank you to our long-standing investors and our new participants joining us for the first time, the many of you who have been following Astor's journey over the years. Your trust and your partnership are the reason we continue pushing boundaries and delivering opportunities designed for long-term success. Tonight marks a major milestone for Astor, the official introduction of the One Astor Income Fund, a strategic income-focused credit vehicle. This is something we've been working on thoughtfully behind the scenes, and we're proud to bring it to you first. Before we dive in, let me ground us in on who Astor is today. Astor has grown into an institutionally backed private equity real estate platform with over 65 years of collective experience, participation in over $3 billion of real estate assets, and a presence across 13 top performing US markets. We've executed 38 investments and 17 successful exits, representing over 3,000 units and 4.6 million square feet of real estate. Our average return since inception stands at a strong 21.3%, supported by disciplined underwriting, deep market knowledge, with a long-lasting developer relationships. This foundation is what makes the Astor One Income Fund not only possible, but incredibly compelling to our network. Now, I have the pleasure of introducing the person who has built this firm from the ground up, shaped its strategy, and continues to lead with vision, discipline, and integrity. Joe Berko, our CEO and founder, is a highly esteemed entrepreneur with more than 30 years of experience in the real estate industry. As the founder and CEO of Astor, he has propelled our company to the forefront of the private equity real estate industry, structuring and executing lucrative investments across major US markets. Joe is not only a seasoned investor, he's an educator, a strategist, and truly the visionary behind Astor's next chapter. We're also fortunate tonight to be joined by several members of Astor's investment team. That's Andrew Milbank. Andrew is our CIO, and he leads our underwriting, deal execution, and portfolio strategy. Alex Mulcree, our senior analyst, supporting financial modeling, market analysis, and execution across all of our investments. And the newest member of our team, Sebastian Lacayo, originations analyst. Sebastian works directly with our developers and sponsor network to source and evaluate pipeline opportunities. Together, I'm very proud of our team. We've worked tirelessly to shape the One Astor Income Fund, and tonight we're excited to walk you through the opportunity, structure, returns, and strategy behind it. So, on that note, it is my pleasure to turn it over to Joe.
We decided to embark on our first fund, a simple fund, not a complicated one, close-ended, and we'll talk about it tonight. Without further ado, let me introduce to you One Astor. So again, the concept is, at this point, after 30 years of doing what we're doing, playing in the field of real estate, investing, advising, representing, helping raise, creating value, we decided that it's time to do a closed-ended fund. Again, the demand really dictates for us what you want, and we see it through your wallets. You're voting through your wallets, and I think it's sort of like concept that we're here, we're listening, and we'd like to make it exclusive and inclusive. So this fund will be a $45 million, representing essentially credit and preferred equity, where we will only look to put projects that are allowing us to do quarterly distributions, whether it is bifurcated debt or if it is preferred equity transactions or mezzanine transactions, any one of those positions that will allow us to provide you, the investor, quarterly distributions. Essentially, at this stage, what we're seeing is interest rate is starting to shrink. The era of trying to get to the 18%, 16% is kind of like winding down. If you look at interest rate, agencies are out there, right, providing debt at very low interest rates, hovering just a little bit over 5%. This is not the case 2 years ago when we started going very strong into the mezzanine transaction, into the preferred equity transactions. And so it's sort of like a short window that we still have to try and capture a good amount of those deals. We are effectively putting together a structure that will be 6 transactions represented over different geographical locations, which we'll talk about in a moment, that will represent the $45 million that we're looking to infuse into this fund called One Astor. All right, so hybrid strategy, projected return ranging from 14.5 to 16%. The range in those transactions basically represents the various positions that you, the investor, have decided to allocate for us. Hold period, we're looking at around 3 years with a little bit of an extension, so we'll call it 3.5 years. We're giving you diversification of locations, diversification of assets, diversification of developers, and of course, keeping in mind that who we want to give money to are highly experienced group. Today, we're going to be representing not just the fund, but also project number 1, which we'll talk about shortly. And that will be sort of like almost our poster child as to the type of transactions we're going to be doing. Andrew, let's talk about the structure, please.
Yes, perfect. Thank you, Joe. And I think one thing to mention, right, is as we're embarking on this journey, which we're extremely excited to do, right? Everything else still within Astor is remaining the same, right? So our due diligence, the developer criteria, the stringent documentation that we have with our development partners, the asset management that we do afterwards, all of that is still here, right? We're wrapping it in a fund now to give an additional layer of diversification to you, the investor, which I think just helps to improve with the risk level, and it gives better certainty of execution for us as Astor, which ultimately leads to better deals that we're able to execute. So we're extremely excited about that. We're very happy that you're all here with us. To talk a little bit more on the fund structure itself. So $45 to $50 million commingled real estate income fund, closed-ended, right? Meaning we are not planning to redeploy the capital upon repayment of a loan or maturity of the preferred equity. And we're looking at a minimum commitment of $250,000 per investor. That's going to be deployed over 12, potentially 18 months. So the way that you would look at that is, okay, I'm going to be doing roughly $50,000 investment per quarter if you're in the $250,000 commitment range. And we expect the fund to go for about 3 to 3.5 years, right? So from the initial deal through the exit or maturity of the final deal, we expect that to be about a 3.5 year period where we are then making distributions quarterly, right, with a target return 14.5 to 16% net IRR based on the investor category, which we'll cover here in a second. And that is going to be a blend of current cash flow, right, the income fund, plus any accruals or bonuses or kickers that we're able to attach onto the deals, particularly on the preferred equity side. And all of these deals are going to fit a specific box, right? We'll talk about the sample allocation in a second, but generally, right, we expect to be certain locations, specific developer track record, right? Either senior debt or preferred equity with returns that reach these target returns. And prior to any deal, with plenty of time, right, at least 30 to 45 days prior to closing, we will be reaching out and notifying, okay, this is the next deal that we plan for the fund. Here's all the information about it. We're now going through business and legal due diligence. We expect to close on such and such date, and that's when X amount of capital will be called from you. So there'll be plenty of notification from us on that. Fee-wise, it's a 1.5% asset management fee. This is assessed in arrears on contributed capital. So it's not assessed on your commitment. It's only assessed on money that's actually been contributed. And that is going to be taken from cash flow to cover fund expenses, administration, etc. And then there is a 12 to 20% promote based on the investor category. And as I mentioned, right, the investor reporting, the quarterly financial statements, investment summaries, what's going well, where we're seeing potential challenges, those will all still be continued as we have with all of our other deals, and that will be done on a quarterly basis as well. So moving to the next page, right? So talking about what is the buy box, right? What is the criteria, right? So we put together a sample allocation, right, to generate where we're projecting the returns. And for most of you, these are going to look very familiar, right? We're New York, New Jersey, Florida, Texas. We're also now looking at North Carolina and Tennessee. Alex will touch on that in a moment. Generally going to be ground up, construction completion, lease up plays of multifamily and mixed use rental assets, right? Projects that we have very good experience with. We've done almost 40 transactions to date at this point. Potentially some condo, inventory loans, condo construction, right, in markets that we're familiar with. And they're generally going to be shorter term deals, right? That's where the development side of it tends to come in. So about 2.5 to 3 years per deal. Always some amount of a current pay, and then some amount, particularly on the preferred equity deals, of an accrual or an exit bonus or kicker. And we are rolling the origination fees into the fund as income. So you'll notice there on the bottom row, whatever we're able to charge as the origination fee, that is rolled into the fund as income. Okay. So very briefly on the next page here, right? Many of you will be familiar from our most recent deals. We have broken the investor categories out into three categories here: core, select, and premier. I will note that this is cumulative across any projects that you've done with Astor that are active. So we'll look at 250,000, right? The minimum investment up to 1 million, 1 million to 5 million, and then 5 million plus. And that is a 14.5 to 16% net projected annual IRR based on the assumptions that we've made on the previous slide. There's a whole bunch of numbers in here. Obviously, we'll share the Excel with you, and we're happy to do one-on-one Zooms, calls, meetings, things like that, to talk through the details a little bit more for anyone that wants to get a bit more granular. And I will just mention very quickly, we may have what are called sidecar investors, right? So institutional groups, other funds that may want to invest alongside us, but maybe by rule of their fund are not able to be an official member of the fund. We would expect their terms to be substantially similar to the premier investor category. All of those things will be transparent. Everything will be disclosed on a deal by deal basis. But I did feel it was helpful to mention that. So Alex, I'll turn it over to you. Talk a little bit about the target markets that we have.
Thanks, Andrew. We'll now take a moment to talk about the markets this fund will target. We have reviewed thousands of deals over the years, and we have deep insights into many of these states. Most of you who have been following us know that we focus on a select number of markets. We've placed investments into the markets that we know really well, such as New York, New Jersey, Florida, Texas, and Arizona. And besides these markets, we've also reviewed tons of other projects in other states where we see strength, growth, as well as opportunities in pockets of North Carolina and Tennessee. So we are also including these markets into our target markets of the fund. For each of these markets, we have the same approach, though. So we look for a strong demographic, sustained population growth. We look for a diverse and resilient job market, which is not heavily reliant on one specific sector, as well as infrastructure and lifestyle opportunities, which increase the quality of life. With that in mind, I'll hand it over to Joe to talk about the fund highlights.
Wonderful. Thank you. So again, high level fund highlights. We're looking at diversification. Diversification is important to us. Your capital goes into one project, two project, three, all six essentially give you better assurance of performance. One goes a little bit longer, the other one performs, and so we have a nice balancing act. flexibility to move between markets, flexibility to move between various sponsors. You'll get a better access to deal flow. We'll no longer have the conversation of, I'd like to put 200 or 300 or $500,000 into the Gold Street project is a good example. We're going to have to deny and say, look, we can only take this amount of money. You'll have the sort of like a beautiful natural distribution. It's not a complex fund. It's a very simple thing. 1 year, we'll pick up 6 projects, gorgeous projects, generating income. Same amount of vetting, same amount of work that goes into each and every one of them. You'll get your diversification, access to deal flow, consistent, fairly predictable, right? When we give a loan, we keep the interest at our reserves, and then we create a very predictable for cash flows. Efficiency in terms of administration, no longer 6 K1s coming to you and explaining to your accountant, you have 1 K1 coming up. And essentially, again, diversification between various positions. So this is why we feel that this is the right time for Astor to do it in a simple manner. And because of all those things that we've mentioned, it makes good sense and it allows you to lock in capital today and lock in good returns today before interest rate will start coming down. Now, why 2026 is a unique year and why start it in 2026, and I'll explain. Previously, we were looking into situations where interest rate was rising. If you lock something today, tomorrow interest rate will be gaining more momentum. And so you could have potentially, your money could be gaining additional returns, but didn't because you locked it in a rising market. Right now, we're in the inverse of that type of a market. Our objective is to lock in as much capital as we can over the course of 2026. I'll give you one example. The presentation that we'll do now on the first deal for the fund, it's going to be a loan. The loan essentially has a minimum floor. So we're locking in interest rate at a certain rate. However, as interest rate starts coming down, the leverage that we take on that loan will allow us to gain even more return for our investors and for the fund. And so we're in an inverse environment where we're locking in interest rate in the beginning of the year and throughout the year at a certain level. And while interest rate keeps on coming down, we're enjoying more and more of that arbitrage because of those financing points. Let me switch over and Andrew can take a look at, Andrew, you want to talk about the first transaction, please?
Yes, sure. So this is a project in the Ironbound section of Newark, New Jersey. I think the simplest way to explain the location is kind of the Williamsburg of Brooklyn, for those that are familiar with New York or some of the past deals that we've done in Brooklyn. This is a 108 apartment Class A multifamily rental project. What we did here, we originated a $23.25 million construction loan. So we will be providing $23 million to the borrower. 16.25 million of that is lined up from a local bank partner that is providing the leverage to us. And we, via the One Astor Income Fund, will invest $7 million into that loan, right? So that's what's called an A-B structure. And we're then able to enjoy the arbitrage where the loan is about 11.25%. The bank receives about 7%. So that difference in the interest is where we enjoy it on the $7 million, right? So we're very happy with the transaction. We're in the final stages now of business and legal due diligence. The borrower has done 2 very similar projects right next to this location. He's built them, leased them up, stabilized them, and is now taking out agency debt. So been very happy with the diligence that we have on them, very comfortable with their ability to perform. And we feel like we're in a very good basis on the loan at just $215,000 per unit. And so for this one, this actually fits in pretty much perfectly, 14.5 to 16% net IRR that we're seeing on this loan. And it has an 18-month minimum interest period with a 24-month term. So we're very happy with that. And we think this is really the kind of ideal situation, right? The ideal kind of project or loan that fits into the fund where we're then able to have a strong borrower, strong location, good collateral, and a good investment that achieves very good risk-adjusted returns for the fund.
So going into some
And
of
I
the
did
case.
just, Joe, just if you don't mind, very quick, there was one, I think one relevant question here.
Mhm,
Two questions we can actually just answer both live. I just wanted to address them first.
mhm.
Uh, do 1031 exchanges work with the fund? That's not something that we anticipate would be fitting with the fund. This is probably not something that would be a fit. Um, I don't know who asked the question. It says anonymous, but does this mean next year there will be no individual investment opportunities anymore? Does everything funnel through the fund? The short answer to that is no, that there will be other opportunities outside of the fund. So when we come across an LP equity opportunity, right, many of you will be familiar, we've done some very successful condo projects in Brooklyn. We recently did two very exciting 350 unit Class A multifamily rentals in South Florida. Those are going very well so far. Deals like that, where there's no current cash flow and everything accrues towards the end, would still be available outside of the fund as we come across them. And, we're obviously planning to continue those relationships with those partners of ours. And in the event that we come across a preferred equity deal that is not able to sustain any current pay, that would be something that we would potentially do outside of the fund. So, our goal here is to launch the fund and focus our originations on these efforts. This is what our investors have been asking for. But at the same time, we're always looking out for our investors, and we have existing relationships on deals that may not have a current cash flow component, and we will still evaluate those opportunities and present them to you as they are available and as we do diligence and think that those are good opportunities.
Wonderful. Thank you for that. So let's go into a couple of case studies. We showed you what the first deal is going to look like. A simple loan. Guys that have been doing the exact same thing over 30 years are looking for financing for their project. They built plenty in the very same area that they're looking to build another building. We actually negotiated some terms where we have some additional collateral from some of the other buildings. We always look for layers in order to make the deal safer and actually more appetizing for all of us. Let's take a look at some of the legacy transactions that we've done previously. Some of you are here in those deals. Dania Beach, for example, is a wonderful transaction to discuss. So here's a project, 293 apartment, Dania Beach, right outside of Miami, right in between Miami and Fort Lauderdale. Gorgeous building. Took the developer some time to build it. A little bit of cost overrun, changes that were probably necessary for the property. Budget got skewed. We, as preferred equity, as senior preferred equity, our position has been incinerated. From day one, we were junior only to the bank, generating an 18% return with a profit kicker of just, I think, a percentage or so, which elevates the return somewhere into the 19%. So on this project, I would have to say if we were equity, we probably wouldn't be looking at such type of returns, but because we're in a preferred position, we get the returns, we get our capital before everybody else. Project's about to exit in the middle of next year where they feel that the interest rate will drive the market a little bit higher. And then our position, being second only to the bank, is sitting somewhere in the $94 million. Our last dollar, we say, is $94 million, where the valuation of the project today is probably somewhere close to $130 million, give or take. So you can see that we're creating a very big cushion. Why is that important? Because in the event that something change, market change, or anything around those lines, we have a very good equity cushion to protect our position. Let's take a look at New Rochelle. Gorgeous building in the Westchester section of New York, built 144 apartment units. We came in, same situation, 18% preferred plus a profit participation plus a kicker is generate for us somewhere in the 22.5% returns. It's a 4-year project. Same situation. Interest rate went up, valuation came down. Our position is incinerated by everything else that's going on. So those are very coveted positions, right? We take less of a risk because of the volatility of markets, and we're able to maintain very steady return to ourselves and to our investors. Those of you that are in the North 7 deal, you know the returns, 21.4 return, 21.4% preferred return, annual distributions. That would have been a classic deal to put into a six asset fund, short-term fund. We started in July. We're expected to exit sometime next year. It was on July 2023. We're expected to exit sometime next year. The building is already erect and far advancing towards its certificate of occupancy. Final case study here is the Fulton, right? There's distributions on this one as well. On this one, the distribution is somewhere in the range of about 8.5% that we give on a quarterly basis, plus an annual catch-up that allows you to generate between 16 to 18% return, depends on your position, core, preferred. And those are the type of projects that we want to make sure that, first of all, we have room for everyone and ultimately give you the opportunity to participate in those. Those interest rates have been the interest rates of yesterday, right? Interest rate is now coming down. We're not going to continue saying this. We've leveraged all of that we could on a high inflation type of an environment where we were able to push capital, our investors' capital, your capital into this project and really generate outsized return, right? I mean, people are shocked sometimes when we tell them what sort of returns we're able to generate without compromising on the quality of developers. Going back to who we are and to sort of like sum up things here, you know, the most important thing for us is Astor Realty Capital as overall, as a fund, as a capital manager, as a private equity that focuses on real estate is preservation of capital. Those of you that are familiar with our better projects are familiar even with our challenging projects. See the type of a fight we have and how preservation of capital is the most important thing. I'm still happy to report that within close to 40 different projects over the course of the last 10 years, we haven't lost a dollar to investor. Doesn't mean that everything has been perfect. We went through a lot of tough stuff, you know, a lot of tough markets, just like everybody else. But we're still committed and we will continue to be committed to no capital loss to our investors. Ongoing asset management is something that we believe is extremely important. We're on top of the market, on top of our developing partners, checking the progress, making sure that things are according to plan and according to budget, and reporting those to you. The above market returns, that's sort of like our legacy. We're able to negotiate better terms because we're coming in as a collective. We come in with a bigger check. We not only have better economic terms, which we're able to pass to you, but also at the same time, we are also able to negotiate better terms for us as control, right? Keeping major decisions, ability to step in if we have to, and so on. Alignment of interest. Our capital as Astor Fund members always goes into every project and aligns with yours, takes the exact same risk as yours. But we also ask the developing partners to make sure that they have substantial amount of skin in the game, because those with skin in the game tend to stay in the game. And of course, the personal approach. Those who have been with us here, some of you over the course of 10 years, know the type of dedication that we have from the team, always making sure that they're available, getting with you on Zoom calls, picking up your phone calls, answering emails. We do the best that we can to stay and remain available and to make sure that you understand that for us, it's a very strong commitment above and beyond just business. It is very, very personal. A lot of our investors are friends and family. There's a reason we call this club the Club of Friends and Family, because this is exactly where we are. Where we are today is we have close to 500 investors, and essentially the club is keep on going, not because of any other thing, but I think it's the service that we provide to our investors, the commitment that we have for the work that we do, and ultimately our ability to actually produce good performance. Laura mentioned earlier that the overall on a quarterly basis, we're at 21.3%. That's across all strategies, right? So if we look at the equity deals are generating somewhere in the vicinity of 25, 26%. Obviously, the more risk, the higher the returns. The lower the risk, the lower the returns. And so on average, we're at 21% overall. 38 transactions, 17 exits to date. Exit number 18 is in the works, so that will happen soon. Our overall portfolio spans across 3 billion square feet with 3,668 units and over 4.6 million square feet coming out of the ground. For the most part, beautiful projects. Assets under management as of Q4 is $258 million market to market. Dedicated team, right? We have great people that have been very, very steadily making sure that this thing grows, making sure that we are producing what we say we'll produce. There's a lot of a love to what we do. There's a lot of passion to what we do, and we'll continue doing that, continue growing together with you. And I can only say that, we're working tirelessly to find the right transactions, going after hundreds and hundreds of transactions, saying no to so many different deals for the right reasons, and making sure that we bring in the right one. There is no such thing to be perfect. Nobody is perfect. Mistakes can happen. Mistakes will happen, but we're doing our best to structure it in such a way to minimize those and to make sure that you get, the returns that are worthy of the type of risk that we take in real estate. Overall, our transactions include deals that are in the hospitality space, like the Caesar Republic, which is a fantastic hotel, deals that are in condominiums, deals that are taking a little bit longer to come out of the ground, other deals that we've exited, some of them we spoke about, and keeping our eye on the ball and making sure that we understand very closely the markets and the operators of the projects that we're in order to deliver the type of results. I'd like to summarize by reading our mission statement. So at Astor Realty Capital, we believe in breaking traditional boundaries by leveraging our collective bargaining power. It is our collective bargaining power. It's our ability to come in with a larger check as a collective in order to get better negotiation terms, better economics. But the most important thing, which a lot of investors tend not to have, maintain control. We are dedicated to leading our community of investors, you guys, towards financial security and growth with integrity, authenticity, and transparency. Because for us, it's not just business, it is personal. Over the course of the last 6 months, maybe the last year, Astor has gained the interest of a lot of large institutions and a lot of large funds. They've been looking at our performance, familiar with our work, and are looking very nicely to come in. Good capital is coming in with the help of God, of course. And we want to maintain our commitment that the first people that will see deals and will have access to those deals are, in fact, the people that help us grow, which is you guys, the club of friends and family. So with that in mind, I want to thank you all for participating this afternoon. And Laura, back to you.
Wonderful. Thank you, Joe. And thank you, everyone, for joining us today and spending this time to learn about the One Astor Income Fund. We've been working towards this moment for quite some time, and it truly does mean a lot to have you here with us as we introduce this next chapter for Astor and our investor community. Over the next 24 hours, we will email you the full offering memorandum, a recording of today's session, and key details about how to indicate interest and begin the onboarding process. Our team, including myself, Joe, Andrew, and Alex, are available for one or more calls to walk you through the structure, answer any questions you may have, and discuss where this fund may fit within your broader portfolio. If you'd already know you'd like to move forward, simply reply to my follow-up email and our investor relations team will guide you through the next steps. Once again, thank you for being here. Thank you for your continued trust, and thank you for allowing us to grow alongside you. We're genuinely excited about what the future holds and look forward to welcoming many of you into the One Astor Income Fund. Have a wonderful evening, happy holidays, and we look forward to connecting with you soon.